What if the most dangerous thing about the future is how familiar it feels? We've heard the anthem of every boom: money is cheap, risk is tamed, a new technology will lift all boats. And we've learned the refrain of every bust: leverage hides in the shadows, confidence turns overnight, and the system buckles where it looks strongest. 1929 taught it, 2008 proved it. The question now is whether 2026 will echo their rhythm. Another crest, another fall, built from the same alluring mistakes. You're watching Hidden Finance, where we tell the stories markets try to forget and decode the forces shaping your financial reality. Today we trace a pattern that stretches across a century, the cycle of exuberance, innovation, and the illusion of safety that precedes every crash. We break down how policy, psychology, and plumbing combine to create fragility, and we ask what it means that the present looks so much like the past. Because patterns don't predict dates, but they do draw maps. To understand a crash, start years earlier, in the soft light of good times. Periods of stability invite risk, and low interest rates make risk feel affordable. Stories bloom that productivity has rewired the world, that policymakers can engineer soft landings on command, that the old rules are just old. Borrowing rises, not because people love debt, but because debt seems harmless. Then, inch by inch, the conditions of a crisis assemble themselves like scaffolding around a building that doesn't know it's about to fall. A century ago, the late 1920s glowed with possibility. Electricity illuminated cities, Ford's assembly lines lowered costs, and radio stitched a vast nation into a single conversation. Markets soared as brokers' loans let ordinary Americans buy stocks on margin with just a slice of cash, while investment trusts borrowed to buy more of the same winners. The upward slope of prices looked like proof that risk had been conquered by modernity. When the Federal Reserve tightened policy in 1928 and 1929 to quell speculation, the cost of leverage rose, but the momentum felt unstoppable. It stopped in October 1929, violently. Black Thursday brought crowds to Wall Street and panic to the ticker tape. Black Monday and Black Tuesday transformed fear into liquidation. Margin calls cascaded as falling prices forced investors to sell, triggering more declines in a brutal loop. Bank balance sheets buckled, and under the constraints of the gold standard, the Federal Reserve hesitated, allowing waves of failures to turn a market crash into a long economic collapse. The lesson seemed simple. Unchecked leverage plus timid policy equals catastrophe. In the wreckage, a new architecture was built. Deposit insurance shored up trust in banks. The separation of commercial and investment banking curbed speculation with insured money, and a new securities regulator demanded transparency in public markets. The message was that rules could tame the excesses that prosperity breeds. Yet finance adapts. Innovations find the edges of regulation, and the oldest temptation, believing the good times are proof of safety, returns with a different disguise. Fast forward to the early 2000s, and the disguise was real estate. After the dot-com bust and a recession, rates stayed low and global capital searched for yield. Housing, tied to the deepest of American dreams, became the perfect asset to securitize and sell. Mortgages bundled into bonds, and those bonds resliced into collateralized debt obligations that somehow turned the riskiest pieces into AAA. Models turned history into comfort, and ratings transformed complexity into a credible promise. The story wasn't fraud, it was faith, widely shared and happily rewarded. The first cracks appeared like hairlines in glass. In 2007, subprime defaults crept higher. Then funds exposed to mortgage securities froze withdrawals because they couldn't price their assets. Interbank markets seized as lenders stopped trusting one another's collateral. Bear Stearns failed in March 2008, rescued in a weekend shotgun deal. Reassurances followed, and for a season, markets believed the worst had passed. Then came September. Fannie Mae and Freddie Mac into conservatorship. Lehman Brothers collapsing into bankruptcy. AIG rescued days later, each event breaking a new piece of the system's bones. The aftermath reshaped policy and politics. Central banks invented new tools, emergency lending to keep credit flowing, and later, quantitative easing to suppress long-term rates and stabilize the recovery. Legislators raised capital standards and demanded thicker buffers, while stress tests became a ritual of reassurance. Banks got safer, but risk didn't die. It migrated. From heavily regulated banks to the shadowed edges of finance where the rules were lighter and the promise of yield still shone. Then came 2020, the Great Shock. A pandemic halted the world, and the response was the largest monetary and fiscal experiment in modern times. Trillions flowed to households and firms, interest rates crashed, and for a moment the economy hovered over a cliff before policy built a bridge beneath it. Asset prices swelled on a tide of liquidity. Meme stocks, SPACs, crypto, and a new alphabet of speculative fervor. When inflation returned, central banks pivoted sharply and executed the fastest rate hiking cycle in 4 decades, trying to cool an economy that had been drenched in fuel. The strain showed up where it always does, in the plumbing. In March 2023, Silicon Valley Bank failed when depositors fled at smartphone speed, exposing the danger of holding long-duration bonds funded by fickle deposits in a rising rate world. Signature and First Republic followed, while across the Atlantic, Credit Suisse met a forced end, not because its assets vanished overnight, but because confidence did. Authorities moved with unprecedented speed, opening backstops and facilities to staunch the run. The panic faded, but the warning remained. Liquidity can vanish faster than the models expect. Today's vulnerabilities aren't carbon copies of 1929's margins or 2008's subprime mortgages. They're quieter and more distributed. Private credit funds have swollen into a multi-trillion-dollar lender outside the banking system, financing companies that once relied on banks, but with looser covenants and less transparency. Leveraged loans, often tied to floating rates, have rolled from cheap money into painfully expensive obligations, especially for firms whose profits never match their debt. Commercial real estate faces a reckoning as office demand sags, cash flows disappoint, and loans written at low rates meet a harder world at maturity. It's not one spark, but a field of dry grass. There is also a refinancing wall looming ahead. Corporate bonds and leveraged loans issued in 2021 must be rolled at rates 2 or 3 times higher in 2025 and 2026, compressing margins and exposing fragile business models. Some borrowers will manage through, others will not, as debt service devours cash that growth can't replenish. Non-bank mortgage servicers, dependent on short funding while handling long-lived obligations, face their own squeeze if delinquency rises. When maturities cluster, small defaults can turn into clusters, and clusters can become a narrative. Even the safest market, the U.S. Treasury market, has shown fragility. Massive government borrowing meets a Federal Reserve shrinking its balance sheet, leaving more supply for private players. Leveraged hedge funds help smooth dislocations with the basis trade, buying treasuries and shorting futures, but their positions rely on stable repo funding and low volatility. In 2019, a sudden spike in repo rates rattled the system. In March 2020, a dash for cash forced the Fed to step in as buyer of last resort. In 2022, the UK saw something similar when pension funds using liability-driven strategies faced margin calls so severe that the Bank of England had to intervene. Globally, cross-currents add uncertainty. China's property developers, once engines of growth, have stumbled under the weight of debt and slowing demand, dragging local governments and suppliers into a long adjustment. Europe digests an energy shock while managing uneven fiscal realities among members, and the European Central Bank walks a tightrope between inflation and stress. Japan's central bank, after years of yield curve control, has begun normalizing, a shift that can tug capital flows and unwind, carry trades quietly supporting risk assets worldwide. In emerging markets, currency swings can amplify any global tightening, turning what would be manageable into something more dangerous. So what are the turning points that fit the 1929, 2008, 2026 pattern? One is time. If inflation proves sticky, central banks may keep rates higher for longer, testing fragile balance sheets and investor patience. Another is the yield curve's sudden steepening from inversion to normal, if inflation expectations or fiscal concerns push long yields up, compressing valuations and pressuring leverage at the heart of fixed income strategies. A third is the first uncontainable credit event, a prominent private credit fund gating withdrawals, a wave of delinquencies in commercial real estate that spills into regional lenders, or a large leveraged borrower tipping over. Individually, these are solvable. Together, they rhyme with crises we've seen before. Concentration is another tell. In 1929, radio and consumer durables symbolized the promise of a transformed economy. In 2008, the Haule rating itself became a talisman of safety. Today, a handful of technology giants sit atop index performance, buoyed by an AI narrative that may well be real, but is priced for perfection. Passive funds and systematic strategies buy those winners mechanically, reinforcing the climb and heightening the danger if sentiment turns. Meanwhile, the rise of ultra-short-dated options can add accelerant, feeding momentum both up and down. If the tremor arrives in 2025, it may not feel like disaster at first. A mid-sized lender stumbles on office loans, a private fund pauses redemptions, or a cluster of leveraged borrowers misses refinancing windows. Policymakers respond with targeted facilities and soothing language, and markets breathe a sigh of relief. We've been trained to expect rescue and resilience. After all, the post-2008 era made buy the dip feel like a principle of physics. The problem with training is that it dulls the senses. The chain reaction starts in the invisible corridors of funding. Lenders demand more collateral, shorten maturities, and pull lines. Those who plan to exit discover the exit is narrow and crowded. Forced sellers hit thin markets, pushing prices down and triggering further margin calls, especially where trades were financed on assumptions of low volatility. The treasury basis unwinds, volatility spikes, and hedges become sources of stress as correlations shift. What seems like isolated incidents suddenly connects, and the story changes from "we can contain this" to "the system is seizing." Consequences always begin with people. Employers freeze hiring, then cut. Small businesses find credit harder to get and more expensive to keep. Households who stretched for homes or cars face payments that no longer fit, while retirees watch portfolios shrink and inflation stubbornly erode purchasing power. In politics, frustration tilts toward extremes and anger searches for villains. Regulators, financiers, technology, globalization. Crashes don't simply erase wealth, they redraw social contracts. The policy playbook in 2026 would be faster and more expansive than in 2008 because the arsenal is larger. Standing repo facilities would flood safe collateral with funding, and emergency programs could be extended into corners that used to be beyond the central bank's reach. Guarantees, explicit and implicit, would aim to stop runs before they start, even at the cost of moral hazard. Regulators would look to pull more risk into the daylight. Central clearing for more instruments, stricter liquidity rules for non-banks, better data on private credit and mortgage servicing. The line between market and state, already thinner than it used to be, would blur further. What, then, are the enduring lessons beyond fear? First, leverage is not just how much you borrow, but how fast your funding can vanish. Maturity mismatches are the spark under every elegant structure. Second, complexity is not sophistication. It is often opacity, useful in good times, lethal in stress. Third, concentration makes systems brittle, whether the concentration is in assets, narratives, or the flows that feed them. And finally, stability breeds the behavior that ends it, as comfort coaxes us to the edge of risk without noticing we're there. For investors, resilience starts with humility about liquidity and an honest inventory of what depends on the kindness of markets. It means understanding the difference between short-term price volatility and long-term solvency, between cash you can reach and collateral someone else can call. For policymakers, vigilance means watching shadows as closely as banks, stress testing connections as much as institutions, and resisting the urge to declare victory too soon. For citizens, it is a reminder that the economy is not an abstract system, but a web of everyday obligations and hopes, strengthened or frayed by collective choices. The past is not a prophecy, it is a warning label. The title promises a pattern, not a date, and that is the point. Crashes do not fall from clear skies. The 1929 mistake was believing prosperity proved safety. The 2008 mistake was believing engineering could outrun risk. The modern mistake is believing we are smarter than the plumbing. If 2026 becomes a year we remember, it will be because we put new names on old behaviors and told ourselves the story would end differently. To change the ending, we must change the story we believe. And here is where we leave you, with a simple charge from our community at Hidden Finance. Remember that markets have long memories, and the only way not to repeat them is to listen. This is Hidden Finance, where we bring the past to light so the future doesn't have to rhyme.